Welcome back to the deep dive. Today we are not looking at history or some far-off future.
Yeah.
We are jumping straight into the deep end of modern finance. We're talking about the strategic thinking of a major financial institution, captured, completely raw.
Yeah, and these sources are just incredible for that. They're direct transcripts from their Q4 2025 earnings Q&A. This is the unfiltered back and forth between Wall Street analysts and the top leadership.
So you get the questions that the market actually cares about.
Exactly. And you see the trade-offs, the risks,
Mm-hmm.
all the stuff that doesn't make it into the glossy annual report.
Right. It's a look behind the curtain at what the smart money is really focused on for 2026. So our mission today is to cut through all the jargon and pull out the three main strategic levers they're focused on right now. First, why their net interest income, their NII, looks a bit muted even with strong lending demand. Second, how they actually plan to hit a really ambitious return target, that's ROCE, through a pretty deep efficiency drive.
And third, the subtle, but I think really profound shifts in how they're allocating capital and, maybe more importantly, their risk appetite now that some big regulatory handcuffs are off.
We're looking for the specific trade-offs, right? The conscious choices they're making to, say, sacrifice a bit of margin today for market share tomorrow.
Yeah, we want to understand the calculus behind the strategy.
Okay, love unpack it. Starting with NII. I mean, this is the core of the business, right? The spread between what they earn on loans and pay on deposits.
It's the engine. And the central question from analysts was, well, it was pretty pointed.
Yeah.
They asked, if your loan growth is so pretty good, why is your NII for 2026 expected to be, like, roughly flat with the end of 2025? It just doesn't seem to add up.
It does feel like a disconnect. Like the market sees them growing, but the executives are admitting they're swimming upstream. They gave, what, three main reasons for this?
Yeah, three big factors. And the first one is, it's the most powerful, the interest rate headwind.
The anchor.
The anchor is a great way to put it. Their whole forecast is based on the forward curve, which at the time was pricing in 2, maybe even 3 rate cuts.
And when rates come down, the bank just earns less on its assets. It puts huge pressure on that NII margin.
Immense pressure. The second factor is all about timing, which is so key for how investors think about this.
Okay.
They see deposit and loan growth happening all through 2026, but the real impact, the build, is going to be weighted towards the back half of the year.
So the benefit isn't immediate. If it only really kicks in, say, in Q3 or Q4, investors won't see it reflected in the near-term numbers. It creates this kind of waiting game.
Exactly. It tests your patience. And the third factor gets into deposit pricing. You know that term, everyone loves deposit betas.
Ah, yes. So how much of the Fed's rate changes they actually pass on to customers?
Right. And they pointed out a really specific split here. For their commercial clients, those deposit betas are expected to be high as rates fall.
Meaning what, exactly?
It means the big, sophisticated clients are watching. The second the Fed cuts, they'll demand a lower rate on their deposits, or they'll just move their cash. The bank has to react instantly, and that eats into the margin.
But on the consumer side, it's different.
Totally different. They said those rates have pretty much already adjusted downward. Either they front-loaded the cuts or, regular consumers just aren't as rate sensitive.
So the consumer side is stable, but the commercial side is where the volatility is. That's a key distinction.
It's a huge distinction. And it explains why they're so aggressively targeting market share on the consumer side, even with the risks.
Speaking of aggression, that's what really stood out to me in these transcripts. Not the NII pressure itself, but their response to it.
The pivot.
This big push into intro APR cards, zero-rate promotions. I mean, that signals a serious hunger for market share.
It's a clear move. Use low-cost debt to grab new customers. And they stressed this growth is happening everywhere, auto, commercial, and card. But that hunger immediately runs up against this newer issue, as they put it.
Potential credit card rate caps.
Right. This push from the administration or Congress to maybe limit how high card interest rates can go.
And the company's line is that they're aligned with the goal of affordability.
That's the public stance, yeah. They admit it's a real problem for people. But they also said it's just too early to know what the impact will be. They're looking for a solution that avoids any adverse impact.
You have to read between the lines there.
You really do. They're looking for a political solution that lets them address affordability without, crushing the profitability of a business that is profitable because it prices for risk.
And that tension, that push for growth versus the regulatory risk, is the perfect setup for our next section on their capital trade-offs.
Okay, let's talk about the quality of that growth.
Yeah.
Analysts really push them on this continued expansion into assets with lower margins, lower NIM, lower ROA.
Yeah, especially in their markets business, things like financing and repo trades. I mean, let's just pause on that. Isn't that what investors hate? It looks like they're just buying low-margin business to make the balance sheet look bigger.
On the surface, it definitely looks that way. But the justification they gave is, I think, a bit of a masterstroke. It's all about capital efficiency.
Okay, explain.
They argued that these assets, which are backed by super high-quality collateral like U.S. Treasuries, they don't attract much capital. Or, in bank speak, risk-weighted assets, RWA.
So RWA is how much capital a bank has to hold against an asset based on its risk. Low RWA means they can do huge volumes of these trades with very little of their own capital tied up.
Exactly. It's not just low margin. It's a brilliant capital hack. They're using their very efficient, very well-capitalized balance sheet to basically displace competitors who can't afford to do these thin margin trades.
And they called it a virtuous circle.
Right. The idea is you do these low-margin financing deals for a huge corporate client today.
And tomorrow, that client gives you the high-fee business, like M&A advisory or investment banking.
That is the key analytical takeaway. They're weaponizing their balance sheet to lock in those high-value relationships, turning thin into fat fee income down the road.
Okay, so what about their actual lending? The asset cap is gone, so they're free to grow, but they kept insisting their risk appetite really hasn't changed. I find that a little hard to swallow.
It's a very carefully tailored message for the market.
How so?
They are growing aggressively in consumer card and auto and commercially, but they have to manage the perception that they're just chasing scale at the cost of credit quality. They have to reassure everyone that unleashed growth doesn't mean uncontrolled risk.
And they specifically mentioned their goal of becoming a full-spectrum lender again, particularly in auto.
And this is where you see that calculated expansion. Full spectrum means moving beyond just the safest, highest FICO score customers. It means taking on more risk by definition.
But they qualified it.
Immediately. They said the growth would still be weighted toward higher FICO customers. And, this is the crucial part, it would not create a tail of risk in their loan book. So they're expanding their definition of acceptable risk, but they're doing it very incrementally.
The highly calculated expansion. Okay, so if NII is stalled by rates and they're taking on more risk, even if it's calculated, the only way to hit those big return targets is to just crush costs.
Which brings us to their efficiency playbook.
Section 3, the efficiency drive. That 17% to 18% ROCE target return on common equity, that is a serious lift. And investors keep asking for a timeline.
So the executives, they grounded this whole ambition in their history. They reminded analysts they've already cut a staggering $15 billion in expenses.
And what's amazing about that number is that during that same period, they absorbed something like, what, $2 to $2.5 billion in new regulatory expenses.
Just think about that. They cut so deep that the savings not only paid for all the rising costs of compliance, but they still had money left over to reinvest in growth and technology. It just speaks to the scale of their efficiency culture.
So what's left to cut? They laid out a whole toolkit for what's next.
Yeah, they're leaning heavily on AI and machine learning for automation. They're still streamlining their real estate footprint, and they're really focused on reducing what they spend on third-party vendors.
So it's a multi-year effort. They were careful to say there's no silver bullet here.
Right. And to prove they're on the right track without giving a hard date, they pointed to their momentum.
The actual performance metrics from 2025.
Exactly. They're basically saying, look at the underlying growth. That's the proof. And the numbers are, well, they're hard to ignore. Credit card new accounts up 20% year over year.
Auto lending up 19%.
Commercial loans up 12%. Investment banking fees up 12%.
Those are the stats they're using to justify the strategy. But that reluctance to give a timeline is real. They just wouldn't commit to a specific date for hitting that 17–18% ROCE.
The word they kept using was midterm. They said it's not tomorrow, but it's also not an extended period. They feel like giving a hard date when the economy is so volatile would be, irresponsible.
It makes sense strategically, but I can see how it would be frustrating for investors who just want clarity.
It's a pressure cooker. They're confident, they're efficient, but they're still a hostage to the Fed and the macroeconomy.
Okay, let's move to the last piece of this puzzle. How they manage their capital and revenue. Given how much capital they generate, they basically said they can handle both strong loan growth and stock buybacks.
They called it a good problem to have.
Which it is.
It really is. It's a luxury. They're sitting above their target capital range of 10.5%, so they're not forced to choose between lending and buybacks right now. They can do both, which is a massive advantage.
And on M&A, they were crystal clear.
No pressure. They feel like their existing franchise is strong enough, complete enough, that they don't need to go out and buy something.
The bar is high, as they put it. Any deal has to be materially more attractive for investors, not just, growth for the sake of growth.
They're focused on organic growth first, using their own capital to fund their own initiatives.
Let's circle back to the markets business for a second. We said their markets NII is growing because of those financing trades, but they clarified something.
Right. That NII growth is partially offset by a drop in fee income. It's a bit of an internal shift.
So it depends on the rate environment.
Yeah, it's a dynamic mix. But the key directional point is that they still expect overall revenue in the markets business to grow in 2026, regardless of what the rate curve does.
That makes the whole picture feel a little less fragile, a bit more resilient. What about their other big fee lines?
They gave a quick outlook. Investment advisory fees, those are mostly driven by the equity markets. Deposit and card fees should be stable as long as the consumer stays active.
And they're optimistic on investment banking.
Very. They're expecting an active deal market this year, both M&A and equity markets.
So if you pull back and look at this from 30,000 feet, what you see is this huge institution aggressively pivoting to growth now that the regulatory chains are off. They're funding it with these deep systemic efficiency cuts, and all the while they're trying to maintain a pretty conservative risk profile in a really volatile market.
That's the summary right there. They are absolutely playing the long game, using their balance sheet to win clients and using AI to boost returns.
So what does this all mean for you, the learner? The real tension we found here is this commitment to expand into riskier, high-interest consumer businesses.
Wow.
The full spectrum card and auto loans, while at the same time they're lobbying on affordability and facing the real possibility of rate caps.
And that raises the big question that I think summarizes the core tension for the whole banking sector right now. The firm says it's going to be a full spectrum lender again, which requires charging higher rates for higher risk,
while also publicly aligning with regulators who want to cap those very same high rates.
Yeah.
So the provocative thought for you to explore is this. How does a banking industry truly plan to reconcile the commercial need for full spectrum lending growth with the stated desire to address consumer affordability? Can they really be a full spectrum lender and operate without adverse impact if rate caps become reality? Or is this just a public relations strategy to buy more time?
That is the financial contradiction we'll be watching all through 2026. Thanks for joining us for the deep dive.
We'll catch you next time.